So welcome to this webinar, everyone. It's a pleasure to have you all here. My name is Swati Chaturvedi. I'm the co-founder and CEO of PropelX, which, as you may all know, is an online investment platform where we enable accredited investors to invest in startups and venture capital funds. Today, we have a very special speaker with us on a very important topic: taxes and tax incentives for angel investors and startups. So before we move this forward, I would like to clarify that this presentation and this webinar is for information purposes only. It is being recorded. This is not a solicitation to buy or sell any securities. We do not offer tax advice, and nothing that is said here should be construed as tax advice. Please consult your own tax advisor for that purposes. With that, I want to introduce Tim, who is our speaker today. Tim is a very accomplished individual. He's worked with startups for the longest time in operations, in management, in tax and accounting. And then he transitioned to investing. So he's an active investor as well as the CFO of Sandhill Angels. Tim has worked and he manages all of the taxes for them. Also works with Band of Angels, manages taxes for them. Very familiar with and very experienced with LLC structures and angel investing, tax benefits, all of the above. And we are very privileged that Tim will also be advising us and working with us on our taxes moving forward for all of our syndicates. With that, I want to introduce and welcome Tim. Tim, welcome to this webinar.
Good to be here.
Good to have you. The way we're going to have this webinar is that we do have a structured set of slides, which are Tim's intellectual property. He has prepared them, and Tim will walk us through the slides. But we want this to be conversational. We want this to be interactive. If you have questions, please put your questions into the Q&A. And our best path forward is that we will be taking questions as they come in the middle of slides, etc. As Tim goes through his slides, at the end of the topic, we will take questions. So please put your questions into the Q&A as they come to you, and then whatever is left, we'll handle those at the end. So please, this is meant to be an interactive session and meant to be participative. If you have questions, please ask them. So with that, let me hand over to Tim. Tim will share his screen and his slides, and we'll go from there. Thank you, Tim. Over to you.
Okay. That good? Everybody sees that?
Yes, absolutely. Thank you.
Okay. Again, hi, folks. Welcome to the show. Since we're going to be talking taxes, I hope you all had a chance to mix up your own cocktail, because that's usually helpful when we're discussing these kinds of issues. Anyway, the topics we're going to cover are on the slide. We'll talk a little bit about the investment vehicle that Swati's group uses, and then we'll cover the other topics which are central to or of most interest to angel investors or early stage investors. It's the 1202 Qsb exclusion for capital gains, and then what happens if you don't meet the 5-year period. We'll talk about the 1244 rollover, and then we'll talk about when it is you can write off a worthless investment and what the guidance is for that. And the other little known one is section 1244, which is the ability to convert or change the character of the loss on an early stage investment from being a capital loss to an ordinary loss, which may be helpful for some of you who have ordinary income that you want to offset. That said, we'll move on here. Okay, so Propel uses a series LLC. It's a Delaware registered LLC. And basically what that means is each investment has its own series, which is the child of the parent master LLC. And when those investments are pulled together and made into a portfolio company, obviously we'll do a tax return for each of those and create the K1, which you'll get. And the K1, for those that aren't familiar with K1s, it's basically all of the pass-through items of income or gain and loss, and the notes that may reflect whether it's eligible for other tax benefits that we're going to talk about, whether it's 1202 or 1244 or whatnot. It also tracks your capital contributions and your distributions and whatnot. It's pretty straightforward. It's what you would use to put on your personal returns, or if you're using an LLC as your investment entity, you'll refer to the K1 to record those items on your personal return. The other nice thing about the using an LLC for pooled investments is a lot of people don't think about it, but from the portfolio company standpoint, it's one line item on their cap table. So let's talk about the section 1202. It's a section of the tax code that allows for 100% exclusion of a capital gain with some limits. Just a little background, this section of the code was actually started in 1993. It wasn't very popular. Capital gains tax rate back then was 28%. And the exclusion only accounted for 50% of the gain. And so if you do the math on that, it was beneficial, but not that great. And then they tinkered with it over the years, where they upped the exclusion, and the capital gains rate obviously changed over the years as well. And then we get to 2010 when they decided to make it 100% exclusion. And that's when the benefits really started to kick in. The other nice thing about the when they tweaked the law in 2010 is that the exclusion also applies to the 3.8% Medicare contribution tax or net investment income. And it doesn't, you don't have to worry about it affecting your AMT tax. So we can go to the next slide. As mentioned, the gain that's eligible for the exclusion is limited to the greater of $10 million or 10 times the taxpayer's basis in stock. So for early stage investors, the 10 times the basis, I don't think I've ever seen that come into play. It's usually because the early rounds are the adjusted basis is so low. But the $10 million exclusion is nice. And that's per issue. So it's not like you can sell a block of that issue in 1 year and then sell a block of that next year. It's the aggregate that you sell over time. But if you have two different companies that you're invested in, it's not limited to $10 million. You can take the exclusion on the issue of the one portfolio and then take the issue from the second portfolio and still recognize the gain.
So,
okay.
Tim, if I will stop you here, let's take an example. Let's assume that someone invested in a company on PropelX, for example, at a valuation of $5 million, and then they had an exit. This is just as an example. Then they had an exit at a valuation of 50 million, right? And this person, for simplicity's sake, let's assume that they invested $1 million at a pre-money of 5. So they had 20% ownership, and then no more money was raised. At 50 million, the exit happened. So their amount became 5 million, or the value of their investment became 5 million. So what would be the exclusion here, or how would they be treating that?
Well, if their basis in the stock was $1 million and they exited and they got 5 million, then they'd have a $4 million gain. Mm-hmm. They'd be under that $10 million cap, and they'd be able to exclude that.
And if they got, let's say it was 500 million in that case, right? So from 1 million, it became significantly more, definitely more than 10 million, whatever that would be, $50 million. In that case, would only 10 million be excluded from the capital gains, right? And they would pay capital gains on the remaining 40 million.
Right.
Fine.
Right.
Understood. So
There's a related question in the chat box.
hang on. So there is a question, when does the clock start for investments by convertible note or safe? Thinking about long-term gains or provisions that call out 5 years.
Right. So we'll get to some of the other particulars about what qualifies for 1202 stock. One of those is that you hold it for 5 years.
Yeah.
And the holding period starts when you are issued the stock. There is some folks that, so if you have a convertible note or a safe, I know Y Combinator thinks the safe qualifies for QSB, but I don't think so. We can talk about that in detail, but you've got debt on this end and you've got equity on this end, and then you've got all this stuff in between. And so what constitutes an equity investment? Is there ownership? Do you have voting rights? Is there a dividend? You know, on the debt side, is there a maturity date? Is there an interest bearing? Things like that. If you're thinking about the Y Combinator safe and their claim that it's Qsbs compliant, I'd be a little leery of that. I think if Y Combinator really thought it was qualified for 1202, it would have gotten an opinion from the IRS, and I have never seen that opinion from the IRS. Now, it takes a couple of years to get an opinion, and it's about $50,000 to $100,000 to get the opinion, and the opinion is only good for that particular set of facts and circumstances. So I'd be leery of that. So convertible notes and safes, in my opinion, do not start the clock ticking on the 5-year holding period. There's one exception to that. I've never seen it, but there was some documentation when the House Ways and Means Committee was discussing this topic back in 1993. They were writing about it in terms of a note could be eligible if it was bridge financing that was going to convert to stock in a very short period of time, 1 to 3 months. So it's possible in that scenario that you could add that 1 to 3 months to your 5-year holding period, but I would be skeptical of that. And if you're close to the 5-year holding period anyway, you know, it's going to be the rare case when you tack that on. Hopefully that answers your question.
Yeah, and then another question related is, if there's 3 exits in a year, each of them, will each of them get the exclusion of 10 million? Or is it 10 million in total across all exits?
It's 10 million per issue.
So
if you're in portfolio company A, you can do 10 million. If you're in B, 10 million, C, 10 million.
Yeah, understood. And the 10 times, there's a question around a 10 times rule, and the 10 times rule can come into play because that's a per year exclusion. Do you want to talk about
let's say your basis in the stock was $5 million. So, and let's say you exited at 50 million. So you've got a $45 million gain. Your basis is 5 million times 10 would be 50 million, right? So you could technically get an exclusion of 45 million that way, right?
Can you?
So, but it's very, I've never seen basis in early stage companies be that high to take advantage of the 10x rule.
So you're saying it's possible, but less likely.
It's very unlikely, but valuations are high these days. So,
so unless you're investing at a high valuation, that 10x rule doesn't come, or often does not come into play.
Yeah.
But I think the nuance here, the questioner is asking, it could come into play because that's a per year exclusion. Do we have any comment on that? Or
it's
is
per
not
issuance.
I see.
exclusion.
Okay, all right.
So you can aggregate per issuance between years, but you're still capped at those numbers.
Understood. Yeah, I just want to remind you to be closer to the mic, just so people can hear you better.
Okay.
Oh man, there's a lot of questions. Let's do this. Let's keep going through. Well, there's one related here. Regarding the 10x basis, if my basis is 10K and the value goes to $1 million, can I exclude only 10x my gain and not the entire 990,000?
Yeah, the exclusion is limited to the greater of 10 million
exactly.
or 10x. So it's a greater than, not a less than.
So in this case, they could exclude the entire 990K, right? Potentially.
Yeah, if their investment was 10K and they got $1 million out of it, they can exclude the whole thing because they're under the $10 million
right.
greater than.
And what if the company has preferred and common stock? Do you get 10 million exclusion for two separate issuances with the same company? And these are two separate rounds, I suppose.
No.
No, right? It's a issuer. Per issuer is what we are saying.
Right.
Okay, cool. All right, there's more and we'll keep answering those, but I think there are some that will be covered in some of the later slides. I'll keep moving.
Okay. All right, so the issue centers around what qualifies for this 1202 exclusion. And here are a couple of things that matter. It needs to be a U.S. domestic C Corp. Okay, you can't invest in an LLC. You can't invest in a Finnish battery company overseas. You know, those don't qualify. It's got to be a U.S. C Corp. The assets of the corporation, basically before and after the investment, have to be under 50 million. If you fall right in that line where the raise takes you over 50 million, then you've got to prorate the investment to see how much of it will qualify for 1202, right? This applies to, as I said, the law came into effect back in 1993, so it applies to issued stock after the 1993 date. It has to be held by a non-corporate taxpayer, meaning if you're a C Corp, it's not going to benefit you. It also doesn't really benefit anybody who's investing through an IRA. A traditional IRA, it's going to get taxed. There's no way to exclude that income when you take your distribution. And obviously in a Roth type IRA, it's after tax contribution. So there's no way to, it's not taxed anyway. So you're not going to see benefits when you're investing through that. We'll talk about the active business requirement on one of the next slides. The stock also has to be held for 5 years, and we'll talk about what happens if there's an exit before the 5-year period as well in a later slide. And it has to be the original issue of the stock. So it can't be, you can't buy it from somebody else and then take advantage of the exclusion. You've got to be the original buyer. And you can get it for cash, property, or services. So early employees who get stock, that's, you know, they should think about if they hold it for 5 years, they would qualify for this exclusion as well.
So I have a few questions on this, Tim. Domestic C Corporation, investors that invest through Propel X syndicates, they do qualify. Can you explain how?
Well, we're investing through an LLC, and the LLC is investing in a C Corp. Because the LLC is a pass-through entity, the Qsb treatment passes through from the LLC to the individual members. And you'll see that when there's an event that qualifies, you'll see it on your K1, where there'll be a note that says this portion of your gain qualified for section 1202 and whatnot.
Got it. Thank you. Thank you for that explanation. Another question I have, secondary stock. So if investors were to buy employee stock options, would that qualify? So because there are, I mean, yeah, would that qualify for this exclusion?
I'd have to think about that. It probably would because it's not issued yet. You're buying the option.
Okay, got
Um,
it. Okay, so there are questions coming up, and so for example, one question was, you said that you'd cover this later, which is if the exit happens in less than 5 years, what happens? We'll go through that. We did cover that if you're investing through a syndicate, which is an LLC, then it does qualify. There was a question, if you say it should be a non-corporate taxpayer. And well, yeah, this, I think we already answered this. What if you're in an LLC with fellow investors, as the band and PropelX has? We said that that qualifies. That, yeah, it passes through. Investors should not be, what is this active business requirement? I think that is one question.
Yeah, we'll talk about that in one of the next slides.
Okay, cool. Very good. Moving on to the next slide.
Okay, so active business requirement, basically, there's two components to it. One is it says 80% of the assets have to be put to work in the business. And so the problem with a lot of the startups is they go out and they raise $10 million and it sits in the bank. It's not really being actively used. It's going to be used over time until they need their next raise. And so that was an issue. And the IRS basically said, okay, we're going to relax that for startups. And our guidance is going to be now that we're really not going to enforce that part of the rule, because we understand in a startup situation, if you get $10 million, you're not going to put it immediately to work. It's going to sit there and be drawn down as they need it. But you need to be aware that that is out there, but it's the guidance from the IRS. It really isn't being enforced. And then we'll move to the next slide, but we'll talk about what an eligible corporation is. And we can go to the next slide.
Okay. All right. What is a qualified trade or business?
Okay, so a qualified trade or business is basically they have to be, building a product. It can't be a service industry, right? So it can't be, as if you read through this, it can't be an engineering firm, an accounting firm, or a law firm. It's where you're relying on the skills of the individual person to deliver their service, right? So, and then these other things don't qualify either: banking, insurance, farming, hotels, mining businesses that are based on depletion of minerals in the ground, that sort of thing. So all of those things are nixed. You can't do that. It's got to be somebody building a tangible product that they're going to be selling, right? And I believe most of our investments probably fall into that category. The one thing that you have to worry about, I've only seen this a couple of times, is you have a group of brilliant engineers. They start a company up, and they're going to design maybe a carbon capture scheme or something of that matter, and it doesn't work out, and they pivot to being a service business where they're now selling their consulting services, and that will wipe out and not wipe them out from being qualified as a 1202 company, basically. Okay.
Yes. Going back, okay, so I do have some questions on the last, going back to the last slide, which is this Qsbs qualifications, gross assets less than 50 million. The questions is, let's say I buy an employee stock option, and typically that happens in later stage companies, right? Which is valued at $1 billion or more, and they have a balance sheet of whatever, hundreds of millions. So would that qualify for the QSBS exemption?
Well, if we're talking about gross assets under 50 million, you look at the balance sheet and you look at the asset side and you add it up. It's over 50 million.
Okay.
It doesn't qualify.
So while an employee stock option does qualify, if you were to buy that, if you were to buy it in a very late stage company, it would not qualify for the exemption.
It's not going to qualify if it's over 50 million in assets.
Yeah, got it. Thank you. So we were on this slide, which is where you said that a services business does not qualify. Let's go to the eligible corporation.
Okay, again, so this just rules out some of the other C Corp possibilities, but they're related to real estate, trusts and corporations that are formed in U.S. territories like Puerto Rico. So these and cooperatives, these don't qualify. We're just looking for straight C Corps formed in the U.S. Yeah, so
Thank you.
those
So
are outlier cases, but for clarity.
Okay. And if a pooled investment, so if someone's investing through an LLC, is it okay that the LLC invest in one company only, or can it invest in multiple companies? I mean, we are using series LLCs that invest in each series invests in different companies. So
yeah, LLCs. The structure I usually see when you have one LLC investing in multiple companies is called a multi-class LLC. And each class in that case is treated as an individual investment in a portfolio company, and you would apply the rules to that specific investment. I'm not quite sure what the question was, but that's how you would apply it.
yeah. Okay, so let's keep going. Other stuff.
Okay, so if you're ever in an audit situation, how do you prove that you had Qsbs stock, right? And so some of the documentation you might want to get from the portfolio company is balance sheets before and after your investment, so that you see if you're under that $50 million issue. You want to be able to prove that they're a C Corp. Sometimes you can get your hands on articles of incorporation and whatnot, or even a tax return, pretty rare. A lot of times the stock purchase agreement these days will list in it that the issue is 1202 qualified. Not everybody does that, but sometimes it's in there, so that's a good record to have. A letter from the CEO of the company or the CFO of the company stating the status of the stock meets 1202 at the time of issuance is helpful. When there's an exit event and you met the 5-year holding period, you want to go back and make sure that the company has continued to meet all of those eligible business requirements throughout the 5 years, right? They haven't pivoted to a service organization, things of that nature. But those are the key things if you want to keep some records to, defend an audit. We touched on this earlier. The stock sold by a flow-through entity. So the LLC holds the stock for the members. The 1202 election does pass through to the members. It's there's not an issue there. A member has what might happen is, say you're in year 3 and there's a change in ownership of the LLC. The new member comes in and an old member exits. That new member is not, because they weren't there originally when the LLC made the purchase of the stock, that's not going to qualify for them. They can't jump in there and take advantage of this. They're basically, you think of it as they're buying it as a second issue, right? A second purchase. So that's one thing to be aware of. The next topic, which is becoming a big deal now, is say I buy the stock in my LLC and it's Qsbs qualified, and I want to gift it to my kids. It's a nice feature to have your kids in the LLC too, so you can do that. And then it's a tax planning, estate planning kind of a thing where you can pass that 1202 election on to your kids or your siblings or your parents or whatnot. And we're seeing a lot more of that now for tax planning purposes, estate planning purposes. And the last thing is, states don't necessarily conform to this. California does not. So while you may get the exclusion at the federal level, a lot of states will not give that to you. So just other things to think about.
Thank you. Thank you, Tim. So let's just, before we go there, because we're still talking about the Qsbs stock, we have a lot of questions. So let's just answer those. So Tim, do you want to answer the less than 5 years question right now?
Sure.
If there's an exit in less than 5 years, how's that treated? Or should we wait till you get to that?
Well, we can go to the next slide, which I think is a rollover provision.
Okay, all right. There we go.
So there's code section 12 or 1045 for a rollover. So the scenario basically is you've held the stock for 3 years and the company has an exit event. And a couple things could happen at that exit event. They could give you cash, in which case, under this provision, you have 60 days to reinvest the proceeds of that exit into another QSBS qualified company. So there's a tight, those of you that are familiar with 1031 in the real estate world, it's the same concept for the QSBS stock. So if you roll it over into other qualified companies, then you can tack on that holding period until you get to the 5-year mark. So that's in a nutshell how that provision works. The other scenario is the company exits. There was an M&A event and the acquiring company gives you stock. It doesn't matter who that acquiring company is. If you're taking stock in exchange, then if you hold that stock for the remainder of the 5-year period, you'll get the exclusion. So if a public company buys a private company and you've now got publicly traded stock, if you hold that for the remainder of the 5-year period, you're good to claim the exclusion. Hopefully that answers the questions.
Yes, so I think that does. We can just go through this entire slide and then come back to some of the questions.
Okay, well, I think I covered most of what's on the slide.
Okay. So there are some questions which reference our previous Qsbs exemption eligibility, and there are multiple questions on this 50 million threshold. Very specifically, people are asking, how are you calculating 50 million? Is it physical assets or is it valuation? In that physical assets, for example, you could include cash that is raised in this current round, etc. So could you just dwell on that a little bit, please?
Well, you're looking at the balance sheet, so it's the basis of the assets on the balance sheet. It's not unrealized gain, for instance. In the case of the raise takes it over the 50 million, you get 10 million in cash. Let's say your assets before the raise are at 45 million and you raise 10 million and now your assets are 55 million. Well, you've gone over the 50 million mark, obviously. So you would just prorate the $10 million, half of it, 5 million, would qualify and the other 5 million would not.
So I hope that answers a number of questions. What do we mean, etc. What you mean by assets, it's what's on the balance sheet. That includes their cash, accounts receivable, everything that is considered an asset has to be less than 50 million. If the actual fundraise takes it over the 50 million threshold, then only the part that was under 50 million qualifies, the rest of it doesn't.
Yeah.
So,
now, look, one of the arguments when you go over to the 50 million mark is, do you prorate it? Or I think the IRS is going to look at it, if the closing was over a span of a couple of weeks, then you're going to prorate it. But let's say the closing is over 6 months or a year. It just keeps going on and on. I would make the argument that the guys that were in the initial closings that got them to the 50 million mark are the ones that deserve the Qsbs election.
got it. Yeah. The 50 million asset threshold is at the time of investment and not enforced at the end of the 5-year holding period, correct? Correct, but please answer.
Yes.
Yes.
Yeah.
All right. For early exit via acquisition, where we had this example of a 3-year, where you are paid in stock, so you get stock in exchange for at the time of the transaction, what counts in the 5-year period? If the exit happens in 3 years, do I hold the acquirer's stock for another 2 years, or does the clock start again? I have to hold it for another 5 years.
The 3 years tax on to the new stock holding. So if you hold the new stock for 2 years, you get the 5 years and you're good.
Understood. So what is the current outlook on how long this Qsbs will last, and whether investments made before any change will be grandfathered? For example, if it's discontinued, will they still get the benefit? Yeah.
Yeah, so obviously there's a lot of talk in Congress right now about changing this rule. There have been some prominent investors who have made a lot of money off this rule. So yeah, the current talk is to reduce it to 5 million instead of 10 million, I believe, and not to grandfather it. And we'll just have to see what they finally settle on, and if it will pass. I guess my opinion is it's going to be really hard to do that. The political situation, the Democrats and Republicans are pretty evenly split. Midterms are up in the air. Definitely if the Republicans take control of the Congress, I don't see this getting changed one bit. And I think it'd be hard to push the moderate Democrats to change it. So you never know, but I just think it's a hard sell to rewrite this.
Got it. So that is up for debate, I guess. Yeah. Another question: investment via Propel X LLC doesn't start a 5-year clock until the target company issues stock, correct? Well, I think convertible note still counts, but I will let you address it, Tim. What happens if we invest in a safe and we invest in a convertible note or preferred equity?
Well, I don't think the clock starts until you get stock. So
convertible note doesn't.
In my opinion, the convertible note doesn't work unless we're in that very narrow band I talked about earlier, where it's bridge financing to get to the stock round, and we're talking about 1 to 3 months. Beyond that, I'd be hard pressed to make that argument. Hard pressed to make that argument to begin with. The earlier safe, no way. Y Combinator says their post money safe qualifies. If I was your tax advisor, I'd say no way. But if you want to make that election and do it, that would be on you. But I don't think it qualifies.
Thank you, Tim. Another question which happened at almost at the earlier part of this discussion. If your stock goes IPO, for example, your investment, and your holding converts to publicly traded shares and you hold it for a few more years, will gains be calculated at conversion or when you sell in open market?
Well, the gain is always recognized for tax purposes when you sell.
All right. Okay. Wonderful. So let's keep moving. So let's talk about worthless securities.
Okay, well, as you know, these investments are highly risky, and they usually end up being written off in a fair number of cases. And so the only place in the code that talks about how to write off a security is this section 165G. And that's it. What you're looking at on the screen is the only documentation that allows you to write off the investment. And there's really no guidance at all as to when you can write it off. So for instance, if a company sends you a letter and says, well, we're filing for bankruptcy, that doesn't necessarily mean you can write the investment off, because you don't know what they can sell the remaining assets for and whether it's going to cover any of the liabilities. And so the problem is you can't write off an investment until you know absolutely 100% sure that you're not going to get a single dollar back on your investment. So that makes writing off an investment difficult, because like I have a company right now we're dealing with that they sold all their assets except for their IP. They're out trying to get bids for their IP, and they're going to prolong it and try and get the highest dollar value they can for their IP, but nobody knows what that's going to be. And we just crossed over the tax year, and they still haven't sold the IP. So is it a worthless investment or not? I don't know, because I don't know what the IP is going to sell for. And so I can't necessarily write that investment off yet. So you have to gather a bunch of data and do the best you can. Are there any employees left? Have all the C-level people left? Have they dissolved the company at the state level? Have they entered an ABC and sold everything? So you have to get enough documentation and evidence that tells you that there's no way you're so far down on the priority list that you're just not going to get anything back. And so that's the measure for when we can write off an investment. And you have to write it off in the year that you become aware that it's worthless. So there's no ability to do any tax planning and say, well, it's the end of 2021. I think this company's worthless, but I'd rather take the deduction in 2022. You know, if you know it's worthless in 2021, you have to take the deduction in that year. Otherwise, technically, if you don't, and you try and do some tax planning and bump it to 2022, in an audit situation, the IRS come back and say, no, you're going to have to amend your 2021 return and take it then. And nobody wants to get involved in that.
So a question here is, for a company that goes under, will the K1 reflect the loss for tax purposes? Again, I think that depends on if we write that company off.
If we determine that it's worthless in the year that we determine that, yes, there'll be a written off, and it'll be reflected on your K1. In most cases, it'll be capital loss, and there'll be a note on the K1 that says, this $25,000 investment in XYZ company, is the result of loss.
Got it. So thank you so much for that, Tim. Let's carry on. I think we've covered part one. Do you want to discuss part two on this slide, or should I move on?
I covered part two. That's
okay.
Kind of the documentation you want. Well, I'm sorry. So securities, obviously, for our purposes, it doesn't matter if it's a note or a safe or an equity investment. all those things will be written off.
All right, thank you. Keeping on going, 1244.
Yeah, I think this is the last topic. So there is another code section, this 1244. It's with regard to losses. And for some people, it's beneficial. Basically, you're changing the character from a capital loss to an ordinary income loss. And this benefits folks, again, who have ordinary income. Ordinary income is typically taxed at a higher rate for most folks than the capital gains rate of 15 to 20% right now. So you can make this election if you want to take the loss against your ordinary income. And the key thing here is that it's only applies to stock that's issued, the first $1 million of stock that's issued by the company. And again, it must be a US C Corp. And it has to be for actual, cash paid for the stock. It can't be stock you received in services. And then there are limits depending on whether you're a single filer or a married joint filer. But it's a nice thing to have. And again, this will be noted on the K1. It'll say this portion of your loss in box 9. It qualifies for section 1244 to change the character from capital to ordinary. And then you can decide based on your tax situation whether you want to make that election at your individual level.
Got it. Thank you. There's a question that came early on, which is, I think, pertinent. So the stock must not have been received for services. What about advisors, advisory boards, and so on? Or even consultants who receive stock in exchange for services. So they do not benefit, right?
Not for this option, not for 1244.
Got it. There was a separate question. If someone's on the advisory board, how is the investment value of your advisory shares established? If we are going to wrap up, I can ask these questions which weren't covered.
State the question again. I'm not sure how it applies to these topics, but go ahead.
I think this is a question more about valuation rather than taxes. So, but I will ask the question anyway. If someone is on the advisory board, how is the value of the advisory shares established? I think it's a 409A valuation, but I'll let you.
I would look to the company to
exactly
place the value on it. Yeah.
Okay. So from what I know of this, it is done by a 409A valuation, and it is going to be stated to you when you get the advisory shares what the valuation was. So,
if there's not a 409 in place, they become pretty cheap to do now. They used to be pretty expensive.
the board can.
You'd look to the last round.
Yeah. So the board has some flexibility in deciding what should be the valuation, but the 409A valuation is what establishes the valuation. So another question is, who is responsible for providing the K1 to reflect the loss? What if it is a direct investment, that is not through a syndicate? Does the company send you the K1? Do you have to request it? I think we should address who sends K1s to begin with.
K1s are generated by pass-through entities such as partnerships or LLCs. If you're making a direct investment, most direct investments are to C corporations. C corporation is not going to send you a K1. It's not a pass-through entity. You might get, if you're lucky, you might get something like a 1099 acknowledging the loss for you. But again, you want to go back and document that the company's out of business. There's nothing left. there's no assets. They've dissolved. The CEO has said you're not going to get a penny. You know, so you want to have some documentation, and then you just make the write-off.
So Tim, on that subject, I do want to ask this question. Let's say a company goes for an ABC process, which is an ABC stands for assignment for benefit of creditors for our audience, which is it is going through bankruptcy light. You know, bankruptcy is the long code, bankruptcy light is ABC. So let's say it goes through that process, and the assets typically can be held for multiple years before there is a sale. So let's say the assets are held for 4 years before there is a sale. And so how long are the assets required to be held by the ABC service provider? And at what point can you recognize the loss?
Okay, so you know, some of those are attorney questions that I can't answer, but you have federal bankruptcy, which can take a long time and be expensive. And you have to, you know, follow the federal rules for going through a bankruptcy process and have a trustee assigned and whatnot to liquidate the assets. So and some states have what's called this ABC, assignment for the benefit of creditors. We have that here in California. And it's a much quicker way to dispose of assets and pay back creditors and avoid a lot of the federal regulation behind filing the bankruptcy and whatnot. So with regard to ABCs, again, there is no time period that things have to be conducted in that I know of. I mean, there might be, but usually they happen pretty quickly within a year or two. It's the issue is when you're straddling December to January, that's when, you know, people want to know the answer. And a lot of times, if you file for an ABC in June, you're going to straddle January into the new year. And unless you have a good relationship with the ABC trustee, and they're being upfront about where they are in the process and what they're expecting, it's hard to write it off until you get the final word. A lot of times the ABC trustee will send out a letter in December, for instance, that says, we just don't expect to pay you back. You know, you're so far down on the priority list. And, you know, in the case of this IP company I talked about earlier, they sent us a letter saying, you know, we're not getting substantial quotes for the IP, and they're below what creditors are going to get. You know, and it wasn't quite there to say you're not going to get anything, but it was close. So it's a tough decision for us in that case.
Thank you, Tim. One of the questions
I might add if you write off an investment like that, and it turns out down the road it does pay off and you get $10 back, then you have to report that income as ordinary income. It'll be taxed at ordinary rates. So that's the gotcha if you write it off too early and you don't have you know, a definitive answer.
Got it. Thank you, Tim. Quick question, going back to the Qsbs exemption, would this apply to an S corporation if you were investing in S corporation?
Yeah, S corporation is a pass-through.
No.
As a general, you probably don't want to make these kinds of investments through an S corp because of some other tax issues.
No, the startup or the investee entity is the S corp.
No, doesn't apply. Well, it doesn't qualify. It has to be a C corp.
Yeah. Another question is, if an advisor exercises options by paying for stock, can that stock qualify for Qsbs?
Sure.
Yeah, this is not an exchange for services. Okay, got it. There are a couple more questions which I can cover, but we are at the top of the hour. This will be available as a recording, and we will also be sharing the slides. And of course, if you have more questions, send them to us. We'll try to get answers to you as to the extent possible. But this will be available as a recording, and the slides will be available. So with that, anyone who wants to drop off, thank you so much for joining us. There's a couple more questions which we want to address, if that's okay, and we'll do that real quick. So one of the questions is, are there any tax advantages if you're using one LLC for multiple investments? So again, the question was, are there tax disadvantages if you're using a single LLC for multiple investments using separate classes for each LLC? In other words, a multi-class LLC, what's the disadvantages? Any other issues or concerns?
A multi-class LLC, if you're using that, disadvantages? Well, it depends on what state you're operating out of. And you want to make sure that your operating agreement in a multi-class LLC is very tight, because only, I think, 17 states recognize series LLCs. And so the other states will typically use a multi-class LLC, but you want to, I've never seen this happen, but you want to make sure your operating agreement is bulletproof in terms of liabilities from one class bleeding into another class. And I'm not an attorney here, but that would be a downside to using a multi-class type investment vehicle. I've never seen it happen. It's not like you're running a trucking company that is on the road with trucks in one class. This is the famous example. And your other class is the warehousing facility. And all of a sudden your trucks run off the road and cause a big liability for you. And the worry is that your liability from the trucking operations now affects the warehouse operations. So that's kind of the analogy that you want to worry about. I will say the nice thing about a multi-class LLC in California, for instance, is that instead of paying the California FTB fee for every single class, as you would have to do in a series, you only pay one $800 fee per year for the multi-class. And the other benefit from a multi-class is that you get, the investors in the multi-class get one K1 regardless of the number of investments they're making through that vehicle. As opposed to a series LLC, you get a K1 for each series. So, you know, if you made 15 or 20 investments in a year, you get one K1 from the multi-class, you get 15 or 20 K1s from the series.
And then there's one last question. How do online platform services with monthly subscription measure up in the product versus services context? So you were talking about the Qsbs exemption, and it must be a startup. It mustn't be a services company is what you said, right? The eligibility, it mustn't be a services. I think the question is, what about an online platform which has a subscription? Does that qualify as a service, or does that qualify does that qualify for Qsbs?
You know, that I don't know the answer on that. I have to do some more research. I think you really have to dig into what they're offering. I mean, are they writing a lot of software and, you know, whatnot in that case? I probably tend to say it qualifies.
Mm-hmm. Yeah, got it. Thank you. So that was it. I think that was a very spirited discussion. Thank you, everyone. Tim, thank you. Any final words from you or things that you haven't already covered?
No, I think the caveat here is that this is a broad overview of these code sections. Everybody's facts and circumstances are just a little bit different. And so you just want to make sure that your facts and circumstances apply correctly. You apply the rules correctly so that you can take advantage of these benefits.
Thank you. Thank you so much, Tim. Thank you for your time, and thank you everyone for your time. Hopefully this was helpful. We will follow up with an email and which will include the slides or links to the slide as well as the recording. You should be able to find that online. Thank you for attending, and take a minute. And if you're not already on PropelX, register for PropelX at propelx.com. Thank you. Thank you for attending.